Welcome back. Now we are here with some moving averages, a 200 period and a 55 period. And we are on a Renko bar setup, okay? Now we also have the percent R for overbought and oversold signals. And let's get those Renko bars put up here. So if you don't already have those up, you'll want to go to your price and your time axis, okay? And your aggregation type, okay? You've got tick, time, and range, okay? You want to be in range, okay? 90-day, 25 tick, you can pick all that. Mark your phantom bars if you wish, okay? And now you can pick range or Renko bars, all right? Now click on Renko bar, and you can adjust those here if you wish. Okay, and I like to keep my expansion area to the right around 50. That's 50 bars to the right of open space. Okay, some like 10, you know, I prefer 50 to 100, and then I can control, you know, how close I see that action, okay? So I keep it on 50. All right. Now what we have here is, of course, our 200, our 55, and we have a new one here. This is the TEMA, okay? Now our TEMA, okay, and a 4-period simple moving average. Now we'll take the 4-period away for now. That way we can only see the TEMA. And let's see, let's make our TEMA, instead of, you know, say chartreuse or pink, let's go with like a darker blue color for it. And maybe I should have just kept it the way it was. Okay, but if you ever want to know what one of these studies are, or as much information as you can get out of it, you come over to your study and click on your question mark icon. All right. Now the triple exponential moving average, all right, TEMA, is technical indicator used for averaging fundamental data. 3 EMAs, exponential moving averages, are calculated consequently. All right, EMA of the price, so it's probably 0 or 1. EMA of the first EMA, and EMA of the second EMA. The final result is the difference between 2 first EMAs multiplied by 3 plus the third EMA. Okay? Not a big math guy, but that's what it is. All right? Now, that EMA is, and here on a 10 period, okay, so we can adjust this, let's say, to a 4 period. We'll click OK, we'll click Apply. Now, what does that look like on our 25 tick? Okay, looks kind of tight, you know, it's high and tight, okay? Not that that's not a good thing, but let's just try that on a further out tick range, or even a regular chart. Okay, a regular chart, you may see some good action with that, but let's take that back out to 10. Okay, and these are Heikin-Ashi candles. So if you want your Heikin-Ashi candles set up, you'll have to come up to Style, okay? You'll have to come into Chart Type, and you have all these different types of candlesticks to choose from. Now this is one we will touch on much later, okay? The equivolume. And of course you've got area. So you can see, if you're using your TEMA on an area chart, where your area starts to get bullish and fill in the green areas, that might be a good indication of you know, a reversal. Now there are a few different stages of a reversal, okay? Yeah, you've got your downtrend, of course, your consolidation, and then your uptrend. And we'll come into consolidation tools and things like that later. But for now, moving averages and the percent R will do. Now, back to our candles. You can have a regular candle that's a candle trend, okay? But I prefer Heikin-Ashi. It shows a cleaner chart pattern, okay? And then for your chart mode, you can pick monkey bars expanded, or seasonality, which is a very interesting type of chart setting as well. So you get to go in and play with those and decide which one works best for you, okay? And which one, you know, you can read the best. Okay, so we'll go back to our standard. Now, monkey bars are kind of cool too. All right. But so far, we're focusing on confirmation and our validations, okay? And if we use TEMA to do that, and let's take our TEMA out once again to what I like to have, the 21 period, or the 20 period, which is also the midline of the Bollinger Band as well. Okay, so we're going to introduce the Bollinger Band now. So let's hit this little minus sign and back out on the, zoom out. Okay, now come into your studies and type in your Bollinger and get your Bollinger Bands, your Bollinger Bandwidth, and some of these other studies, and then some of these custom studies that you'll get later, if you don't already have them. Okay. Now, we've got our moving averages. All right. Our TEMA is real close. And we've got our Bollinger Bands. Now, our Bollinger Band midline is typically a 20-period moving average, is what it's associated with the most. Okay. And if we were to take and change our, let's just say, we'll get rid of our 200 for now, and we'll change our 55 over to a 21. You can see how it associates with the Bollinger Band midline, how it associates with the triple exponential moving average against a simple moving average, okay? And apply. Here we go. All right, so you can see this 21 period simple moving average does move right along with the Bollinger Band midline, which is why you don't always need to have the Bollinger Band pulled up. But I like the Bollinger Bands because you can see some very interesting things in the Bollinger Bands. You can see price coming up, you can see it dipping out, sometimes even in very distant, far off patterns, you can see even other really interesting things, how things, like it's a fountain almost, okay? And I think some people just have way too much time on their hands and they're able to create art with these, because I have seen some very, very interesting pieces of art in Bollinger Bands, to tell you the truth. Okay. So now you have your Bollinger Bands up, and you know that you can respect the boundaries of the Bollinger Bands. Now, if the midline is about 20, then we can probably expect this to be, I'm not sure what the deviation is on this particular setup. I believe it's 2, and I personally like 4. Okay. See, it's down 2 and up 2, okay, but I personally like 4. So, at least down 4 anyway, and that will help with a lot of the noise that you feel, or will make you feel like price is dropping through the Bollinger Band, okay? Typically, price just doesn't drop out of the sky, so we have to keep that in mind. But it does respect the boundaries of the Bollinger Bands, okay? And this center moving average, or the center line of the Bollinger Band, which is also a 21 period moving average, Okay. So our 21 period moving average, even the TEMA being on 21 periods, still is more reactive. Okay. So keep that in mind. We can use the 21 period simple moving average or the 21 period TEMA. Okay. Now let's go back to our Renko bar setup. Okay, and we'll have to zoom out here. And what an interesting way to look at that data. And that is why you are here. You're here because it's different. And it's something you've never seen before. Okay. These are the things you are not going to learn in those other courses, I promise. Okay? Now we see this is definite validation, okay? And then we see confirmation on two different moving averages. So, I mean, it works. All right, and validation again. No confirmation, but it is striking above this line. It is a very bold trend there. And it validates out. Okay, this is market noise. All right, on both moving averages, if we waited for the signal, here is the sell or the short sell signal. Okay, and then buy in. Okay, then we would have lost money in this trade if we didn't catch it. Okay, but here's confirmation for a buy-in and another winning trade, validation. All right, wonderful. So now you're starting to see how we can use both of these moving averages together with your Bollinger Bands and paying attention to what is oversold, okay, and overbought. Very important. All right. Let's take a look at a few more examples here up close. All right. Here's where we validate out of this trade and we no longer consider it, okay, for any actionable trade, okay. And then here's where we start to look at it again. Here's where we jump in our trade, okay. Now striking above this is a good sign, okay. So we would consider staying in, but if we get validated out, that's fine. We get validated out because we're going to talk about stop losses here, okay. Now your stop loss should typically be set, all right? Now, this is a controversial thing, but let's just say you set your stop loss 20% below ATR, okay? Your average true range, okay? So you get your ATR trailing stop or your ATR. So we're going to put them both up here, all right? And our ATR trailing stop. All right, and now we can see where those would be. All right. Now, all of these studies are not up there, but let's see, ATR trailing stop, and our ATR is down at the bottom, which is also a Wilder's ATR. Excellent. So this ATR seems to act an awful lot like a parabolic SAR. Okay. Now, on the bottom, we can read it and see how it reacts to price action for average true range. Okay. Now what we do is we find our average true range and then we set our stop loss, okay, just a little bit below it. All right. Now they would say set it at this, but that's not necessarily correct. So, okay, so if you're shorting and you set it ATR, it's going to spike up and hit that. But if you set it at 20% above ATR, some people would say 15. I say 20 to be well out of the range. Yes, you would lose a little bit more money, but the risk of getting stop lossed out, which you will already know of or will find out, can happen, okay? So once you get better, you'll start to use mental stop losses and take care of your trading hand on hand. And then when your algorithm is trading, you won't have to worry about it at all. All right? It will be an automated process. Now, That is an awful lot to take in. So if you have to, go back and watch the video again, play with these indicators, take your time, and I will see you in the next video.